Hi, I'm Peter Rose, founder of Longwood Currency Trading, and the topic I'd like to discuss in this video is the dangers of reverse staging into far out of the money positions. In intermediate trading, you start to get into staging positions, and the assumption is if you're an intermediate trader, you're trading mid five-figure account, let's say, in order to trade at least 5 lots. You got to be trading at least 5 lots, full lots, not minis. I don't believe in that, but you've heard me rant on that before. But in any event, when you have that lot size, that gives you the ability to enter your initial position and then start to stage in from there. And the assumption here is that you are in a profitable position. In other words, you've done your initial entry lots in. So if you're trading with 5 lots, you may have entered with 2, let's say, and now you're getting ready to stage. Well, there are questions as to when you begin to stage, what the distance is to the average position value, and all that other sort of stuff. But the issue comes up later in the process, and that's what I'd like to identify in a little bit more detail for you. Because the consequences of not understanding this aspect of staging could cost you your account. But first of all, I've got to go out and pull in some wood from the wood pile, because it's going to be a pretty snowy day, as you can look if you look up in the sky. I don't know whether you can tell that or not, but this is the middle of December of 2022, and we're expecting a fairly significant snowstorm up here in New England right now. Not any really big stuff. We could get 6 to 8 inches of snow. I think in some of the higher elevations. I mean, we're in the lakes region up on a small mountain, but when you get up into the larger elevations, they're talking potentially over a foot. So I just want to make sure I've got enough wood in order to feed up that wood stove, because it's going to get really cold. So there's the stash of wood for the season, and we go around here to the other side and check out what I'm going to start pulling in here, because what happens is that the snow gets piled up all in here when the plow guy comes to do the driveway, and so we're trying to eliminate as much wood in this area here as possible so that access to the rest of the pile is on the other side. So what I'm doing is I'm discussing staging in this wood into the house in order to make sure I can get to it because of the snow that's going to pile up here. So let's use that analogy and talk a little bit about this concept of reverse staging in far out of the money positions. But first, before I get into the rest of this video, I had to actually bring some of that wood in because I was a little short. So there's my stack of wood for the next few days. We're all set to go. So let's go inside and get a cup of coffee, and then we'll go into the library and discuss this. All right, let's get this going here. Get some coffee grounds. So, coffee in hand, ready to go. Sorry for the little travelogue, but I have wood to pull in, and I thought I'd share that experience with you. As I mentioned in a previous video, there's a difference between building a position and then staging into the position. Building the position is what you do in the entry phase of your position. You do your entry, and then you might add a couple of lots. So you're adding lots to the position, you're not staging in. You're building your position. Once that position continues to go into profit, that's when you're going to start to stage into the position. So here's what happens. Let's say you wait a long time before you stage in because you are doing, oh, I don't know, maybe you're lightly staging in at the beginning, and then you see it looks like this thing is going to go forever, and then you go in a little bit heavier. In any event, the average price of the position each time you stage in goes up, which brings that average closer to your current price. So at the current price, after you staged in, you've got a price up here. Now you drop a couple of lots in. Then you go up a little bit more and you drop a couple of more in. Your staging is a little bit closer together because the thing is really starting to take off. All of a sudden, price swings around and drops back against you. You've got, say, 3 or 4 lots in the position up to that point where your last 2 or 3 lots were staged in. The average position price is now very close to that. The price whips around against you and goes down through the first two the first 2 of the last 3 stages that you've done. So now you two of those 3 or 4 lots you're underwater on. You drop another one, you're underwater again on those, and then all of a sudden you are in negative territory. But you're certain to a degree that that price is going to continue to drop. So you wait for a while and then you start to stage in again. Price whips around and goes back up against you, maybe back to that last take point. But your average price now has been pulled down. You go through that price, and then it turns around and goes against you again. And that's where you get into trouble, because you loaded up substantially. You're now at a much higher average price, right? Current price goes below that by not that much, but significant enough to take the position to a negative value of maybe, let's say you've got 6 or 8 lots in there, and going on $70 a pip, and you're now 40 pips out times 70, $2,800 $2,800 underwater. You're going to have to get out. So the problem is that you've been staging into that far out of the money position. You're banking on that price continuing to, in this instance, to go up, and it didn't. It's turned around against you, and it's confounded the efforts that you've put in to adding to that position by staging in, but you're doing that far out of the money. It's come back against you. You've staged in because you think that it's going to go back up, and it doesn't. It continues to go down, and it's just it becomes a nightmare. It's an experiential ability that keeps you out of those situations, but there's also a lot of theoretical background that you're going to need to do. I mean, I'm writing a computer simulation program about just those issues of staging in at different places relative to the current price and the average position value and where your stop is going to need to be. The trick is that if price turns around you at, let's say you stage in a lot and price turns around you right there, let's say you stage 2 lots in, so you're losing $20 a pip. So if you're saying, well, I've got a 20 pip stop, and so if I lose that, I'm out $400 on that lot. But if I'd staged another 2 lots in right below that, before that, then not only does that first or the last 2 lot position go underwater, but the second one goes underwater. So now you've got $40 a pip times 20, and you're $800 out. You see what happens when you get that entry point for each stage level. When you compress that too much, then it affects the average position price, such that a quote normal retracement of that price is not only going to take out one, but maybe two or three of the last positions that you've staged just to get through a mediocre distance. Because what you've been trying to do is make sure you've got enough lots on the table that as the price comes back in your favor, that you've more than made up for the lots that you're going to lose on that are far out of the money, right? So you have to be really, really careful about when you're negative staging. In other words, staging when you're out of the money, and you're saying, well, it'll go so far, and I'm going to be okay because if I hit this stage point, then I'll go out. I'll set a stop. But I don't think it's going to do that. I think it's going to turn around and continue to go up in my favor. The problem is it continues to go up in your favor. You add more, and then it turns around and goes against you again. And it's horrendous. You have to be really, 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 really careful of that. But I just wanted to do a short video for you to make you aware of this particularly nasty situation that you could get yourself involved in. Number one, if you start staging too early in your experience level, or number two, if you start staging when you don't really have enough lots to get yourself out of a mess and work your way out, you could run into some pretty serious trouble. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.